Now we are moving to, I think, the most exciting part of today's, and I will pass my duties as moderator to other board member of Danish Chamber of Commerce, Ramūnas Bičiulaitis from Danske Bank, and he will take the part to moderate with Lars Christensen and his presentation. So Ramūnas, please take my duties for a while.
Thank you, Laimonas, and hello to everybody once again. So today it is my privilege to introduce Lars Christensen, the international economist, who will present his views on global economy and financial markets in the world, as in the way of considering, the crisis situation impacted by COVID. He will focus on the implications for the Scandinavian and Baltic region. I would also like to mention that Lars is a good old friend of Lithuania. He was speaking a number of times on different stages in Lithuania. He was speaking also on the stage of DCC some years ago, and still keeps actually really close relationship with Lithuania. Recently, he has also moderated the interview with Ingrida Šimonytė, and it is agreed that actually this is going to be repeated on a regular basis. Lars? So
Ingrida and I are still friends.
Yep. So, and it is also important to mention that back in 2007, Lars was, the economist who has precisely forecasted the deep recession in the Baltics of 2008-2009. And I trust that actually quite a number of companies, they have benefited quite well because of this, forecast and protected themselves from the recession. Again, I would like to mention that at the end of the presentation, Lars, I believe you will allow to ask some questions of the participants. Please also provide your questions on the chat in the Teams. And we have also some questions collected from participants of today in advance. So Lars, again, the floor is yours, and thanks in advance for being a part of this meeting today.
Thank you, Ramūnas, again, and thank you for the ambassador also for his words on the situation. Yeah, I'm happy to be back home in Lithuania. I really wish I was there on the ground rather than sitting here in my living room in Frederiksberg in Copenhagen, or in my dining room it actually is. One of the things about the whole situation, of course, is that I haven't traveled personally since March 3rd or something like that last year. I think it's the first time in 20 years I haven't left Denmark for a year, and one of the countries I obviously over the past many years have been coming to regularly has been Lithuania. So I dearly miss being back there, and I hope to be there as soon as possible. I'm also very happy to hear that hopefully those vaccines that the Danish government for mysterious reasons don't want to use will get to use in Lithuania, hopefully. But I better not comment on the political situation in Denmark for the sake of the good mood, and rather go on to talk about the global economy. Just to make sure, Ramūnas, my time, how long do I have exactly?
You got half an hour.
Yes, good.
And
just to make sure that I don't, because as you know, I can speak for very long about economics and football and basketball and other stuff. So we will keep it within half an hour, and then please let the comments or the questions coming. I will just try to share my presentation here. Do you have it on the screen, all of you?
Yes.
Good. So the headline: post-COVID recovery fast but also inflationary? ? Actually, all of us are feeling depressed about the situation. Many companies are struggling, particularly in certain areas that has been affected by lockdowns and closed borders and so forth. But I frankly am quite optimistic about the outlook for the global economy and also all of the also for the Nordic-Baltic region overall. But I have some concerns that I will return to. Obviously, in the present situation, it's impossible not to talk about COVID-19. And I thought I would just share some numbers with you. I have very strong views about how this whole crisis has been handled, or rather mishandled, by policymakers and governments around the world. One thing that I think is interesting from the perspective of this discussion now pops up also in Lithuania about the third wave is to look at how developments are across countries. And one of the factors I think we have completely missed in the discussions is how much the COVID virus is driven by seasonality. If one look at the influenza season and the movements in COVID, it has been exactly the same across countries. And as you will also see here, I have the number of deaths, and this is normalized, so it's per capita. Denmark, Sweden, the United States, and Lithuania. And you can see, we have had different approaches in different countries. Lithuania have had a very, very strict lockdown. Denmark has a less strict lockdown. Sweden has a much less strict lockdown or no lockdown. And you can see actually the pattern of when the death started rising and when it started falling followed the exact same pattern. And actually the US as well. Why is that? That's because they're all on the northern hemisphere. Personally, I don't think that Lithuania is facing a third wave. There's an uptick now. Some of that is post-lockdown, but I strongly believe that the seasonal effects will kill this. And if one looks at the financial markets, that is of course also what the financial markets are telling us, that this is essentially over. And there are some concerns, and of course politicians are overly concerned in my view about the situation. But as you can see, the seasonal pattern is very much the same. Had you put influenza season on top of this, you would have seen the exact same pattern, and therefore in May the number of infected and dead and hospitalized will decline steeply across the Nordic-Baltic region. I'm not a virologist or epidemiologist, but I am an economist, so I know seasonal patterns very, very well. We have it in all economic data, and surely this is what drives things very much. Another thing, of course, that is positive here is the number of vaccinations. We have now in Lithuania reached 20% of the population which have received the first injection, and among those, all of the vulnerable groups, those above 70, those with diseases and other things have been vaccinated, and a lot of the staff and medical staff and so forth and teachers have been vaccinated. So that in itself will contribute to strongly reducing mortality. We see that in Britain, of course, where they are much further ahead than we are, should I say, in the EU with the vaccinations. So I'm very, very optimistic about the corona situation. I know that the politicians hate this, but actually this is over. Within the next month, we will see a very steep decline in hospitalizations everywhere in Northern Europe. In my view, we've already seen a lot of it, and this third wave will be short-lived. So I'm quite optimistic. And if you look at the US and you look at the UK, the picture is even more positive. Take a state like Texas, where they actually abolished all restrictions on March 10th. The number of deaths, number of hospitalized, number of infected people in Texas has just continued to decline even after all restrictions have been removed. We've seen the same all over the southern states of the US, and this is a seasonal pattern combined with the vaccinations and combined with natural infections have created herd immunity, is now meaning essentially that this is over. The spring is here and then summer is here. And when we get to the autumn, most of the vulnerable people and large share of the populations in Europe will have been vaccinated. So the COVID-19 will not return in the autumn in any major sense. So of course, that is what the financial markets are telling us. And that then moves us from the lockdown situation to the recovery. And a way to illustrate how that has been going on is to look at unemployment. The blue line here is US unemployment. I have called the present crisis the shortest recession in history. I'm actually inclined to say this is not even a recession. And you say, how can it not be a recession? People are unemployed and nothing is happening in the economy. Yes, but it's not a real recession. I have compared this to, I have called it an unplanned, very expensive and very bad vacation. So if you go to France, for example, in August, there's always a recession in France in August. Why? Because they have their summer vacations in August in France. So everything is closed down. So if you look at economic data in France, there is no economic activity. In Lithuania, every year there is a boom in retail sales in December, not because the economy is doing well, but because it's Christmas. So these seasonal patterns, of course, happens, but it's also essentially this kind of thing that happen here. We have closed down the economy, and once we open up, we remove the lockdown restrictions, everything wakes up very fast. Obviously, certain sectors have been suffering, but underlyingly, nothing is broken. And you can see here, if you look at the blue line, the unemployment in the US, you can see when there are recessions, for example, in 2008-9, unemployment rises, it comes down relatively slowly. If you look at what happened this time around, a very, very steep increase in unemployment in the US, and we saw unemployment go to 15%. Back in May, when we hit 15%, I wrote a blog post on my blog, marketmonitorist.com, where I said unemployment would drop to 6% by November. A lot of people told me that I was completely insane. And as you can see, I was not insane. I was nearly right. In November, unemployment in the US dropped to 6.9%. Why? Well, because it was a temporary closing down of the economy. Once the economy was closed up again, there was a return to the labor market and things improved dramatically. And if we look at now in the US, things are improving very, very dramatically right now. So it looks very, very positive for the US economy and for the global economy. But obviously there are those sectors, particularly in Europe, where we still have lockdowns and restrictions, that are suffering. Traveling, hotels, restaurants, cafes, everything related to tourism, everything related to sports is affected by this. But industry is doing much better, and underlyingly income development both in the US and in Europe is quite positive. So I'm actually have been having the view for nearly a year now that we would return from this quite fast, and the economic data shows this. One thing that I have been concerned about initially was whether this would turn into something similar to 2008, 2009. Because when we close down the economy, we put restrictions on what we can produce, what we can consume. It's essentially a supply side shock. We restrict production. But what happened to the demand side of the economy? Initially, it looked like demand collapsed. And a way to look at that is to look at what happened to financial markets. The financial markets back in March, April last year told us something very bad is happening. A way to look at this is look at US interest rates. This is bond yields in the US. The red line is the 10-year US government bond yield. And you can see a year ago, in March, April, the bond yields dropped very significantly and has actually remained quite low until 2 months ago when yields started to rise again, but they're still below 2%. One of the things that really drove down bond yields initially was the fact that inflation expectations dropped. That's the blue line. That is the implied inflation expectation in the bond market, and that really caused a steep decline in bond yields. And that was telling us that markets were concerned initially about also demand collapsing. And that would have been similar to what then happened in 2008 and 9. However, we also know that the Federal Reserve and the ECB and central banks around the world came in very, very, very strongly and very early on and eased monetary policy. They were much more reluctant doing that in 2008, and therefore it developed into a deflationary crisis that developed into a banking crisis. We avoided that this time around by swift actions of the central banks. And you can see now the blue line is inflation expectations. And we are now actually at the highest levels for US inflation expectations in 6-7 years. And we are actually now at 2.5% inflation expectations in the US, above the 2% inflation target of the Federal Reserve. And therefore we now get to this discussion, will this actually become inflationary? Should we, for the first time in many, many years, start to concern ourselves about inflation? And I believe we should concern ourselves about that. And all of you who has anything to do in terms of imports will know that you have already seen import prices start to rise quite steeply. When you talk to logistics people, people who works in transportation, they will tell you about quite fast rising prices now, and we're seeing some very significant inflationary pressures. Interestingly enough, of course, the Federal Reserve, the Central Bank of the US, has said it will keep interest rates unchanged until 2023, and it will continue to do quantitative easing to print money. Well, in a situation where unemployment is coming down very fast and it's likely to come down below 5 in the next couple of months, and inflation is now at 2.6%, and inflation expectations are above 2.5%, well, you're going to ask yourself, can the Fed really maintain the stance that will continue to print money and keep interest rates at 0? I don't think so. So a major risk is actually at some point the Federal Reserve turns around dramatically and have to tighten monetary policy in kind of a shock and awe effect, because inflation expectations suddenly accelerate dramatically. I would really be keeping an eye on that in the next couple of months. But before I return to more of that, let's see where the US economy is. So another way of looking at this is just to look at nominal GDP. That's the blue line here. So nominal GDP, of course, is both the production and prices together. And the red line is private consumption. You can see the two follow each other very closely. Nominal GDP in the US has since 2010 been rising around 4% year in and year out, more or less on a straight line. And you can see then we got the shock and we dropped significantly below that, but you can also see we have rebounded very strongly towards the old trend. This is not what happened in 2008-9. It took much longer to recover from that. And now we actually closing this gap much faster. You can see here, this is essentially the same graph. The gray area is the gap between the underlying trend and where actual nominal GDP is. It's around -3% by the end of 2020, because we don't have Q1 GDP numbers yet for the US, but it will have closed even more. And by the third quarter of this year, that output gap will have completely closed. And unemployment will be below 5% most definitely at that time. So you are at full capacity within a few months from now. That's not likely to be the situation in Europe, but it's likely to go much, much faster than what we saw previously. And the reason for that is that this was not a demand shock. This was a lockdown shock. Once we open up again, economic activity returns again. It's like you shut off the factory, you turn on the factory again, and things start going immediately. And we can see that on all economic data, that is happening particularly in the US, and will also happen in Europe once we get the politicians to move away from the lockdown phase. One thing that has been happening in the US is the fact that once we got the crisis, American politicians moved very significantly in terms of easing fiscal policy, much more so than we saw in Europe. The Trump administration essentially decided to send a large check to every American household. And what they did was essentially what is called helicopter money. My old hero, the American economist Milton Friedman, introduced the concept of helicopter money in an academic article in 1968, where he described it not as a policy proposal, but a way to illustrate monetary policy. He said, you know, the central bank governor flies around in a helicopter and drops money across the country. This is essentially what they did in the US. What they did was we sent a check to every household, and the government then got a deficit. So how do you fund the deficit? By issuing government bonds. Those government bonds, the Federal Reserve was buying from money it was printing. So essentially, the central bank was printing money, and via public finances was handing that directly to households. And you can see the green line here is deposits. This is US deposits. And you can see that prior to the shock, the red line and the green line was growing more or less in parallel. The red line is the consumption of US households. The green line is their deposits. So they're getting money into their accounts and they're spending it. So this is essentially what is happening constantly. But then you can see in 2020, everything is closing down. The hairdressers is closing down. The baseball parks are closing down. Stadiums are closing down. The restaurants are closing down. You're not going anywhere. You're not traveling. So you're essentially only buying your essentials. So private consumption collapsed. But what happens to deposits in people's bank deposits? They increased very dramatically. We have seen a similar thing in Europe, but to a much, much less extent. You can also see it to some extent in Lithuania, but much, much less so. But in the US, this is a very dramatic effect. And now the Biden administration has essentially said it will do the same thing. So looking into 2020, you will get another jump in deposits. And so what are deposits? Well, deposits is part of the money supply. The money supply is composed of notes and coins in circulation and bank deposits. So what have happened to the money supply is that you have seen a very, very dramatic increase in the money supply. So the blue line here is the money supply in the US. It's up by more than 27% compared to a year ago. This is the fastest growth in US money supply since the Second World War. You can see in the Eurozone, of course, therefore also in Lithuania, money supply growth have also accelerated. We're now growing by more than 10%. This is quite strong money supply growth, and it's the strongest we have had since before the crisis, but it's still nothing compared to what we have seen in the US. So, but both places we are having quite significant monetary stimulus coming from this. A way also to illustrate this is to look at all that deposits that are in US banks. How much money are we talking about? Well, what I've looked at here is I looked at how much money are in the deposits relative to what would be the normal situation given consumption and incomes. And you can see here at the moment, or by the end of 2020, actually the moment is higher. You have more than 14% of GDP in deposits. This is just surplus deposits. So once things are opening up, that money should be expected to return to the economy. If that comes in one shot, that's a massive. But let's split it out over 3 years. Then we will have 4 or 5% of stimulus directly from consumers, which you could add on top of economic growth. This might be this is before they got the Biden check. This is only the Trump check. So even more money are coming now in the magnitude of 10% of GDP. So this is the magnitude of monetary and fiscal stimulus have never been seen in US history before in peacetime. This is a massive stimulus to demand, and in my view, it's way overblown. And obviously, with unemployment down to nearly normal levels, and the economy within the next 3-4 months back to full capacity, what will happen? You know, what happened? You know, well, it's easy to understand for anybody living in Lithuania. For those of you old enough to remember the end of communism, you remember what happened. So you have communism, and in the case of Lithuania, also independence. But you know, if you have regulated prices, you get a salary every month, but when you go down to the shop, there is nothing to buy because prices are regulated. So everything is rationed. So you can buy toilet paper, some old fruit, but you can't really buy what you want. And so what do? You accumulate money. That money will be in your deposit or in your mattress at home. So you will just have, so people are making more money that they consume because there's nothing to buy. So what happens at the end of communism? You end communism, you get a free market in pricing. So suddenly there are things to buy in the shops. You spend your money and prices skyrocket. That's what happened in Lithuania. That's what happened in Poland. That's what happened in the Soviet Union or in Russia at the end of communism. There was this money supply floating around that you couldn't use. And once you could use it, it turned inflationary, at least in a transitional period. Lithuania was a little bit different because you also had a currency reform that went from one currency to another and now to a third currency. But maybe the most clear example is in Poland. There you really had it because they also have price liberalization from one day to another. And so what I'm saying here is essentially we're going to see that in the US now. We're going to see a situation where people have in the magnitude of what accounts to between probably 15 and 20% of GDP in excess deposits that they want to spend. That once that money flows back into the economy, it will push up prices. And a way to illustrate how much money is that, I have here the blue line is the US price level. The orange line is what the price level should be given the money, the scale of the money supply. At the moment, the money supply tells us that US prices should be at least 10% higher than it presently is. 10% higher. And what happens? Well, what is likely to happen is that inflation is likely to spike over the next couple of months. And you know, I wouldn't be surprised if we see inflation in the US close to 10%. We have already seen we got the numbers for April from March, already quite a substantial pickup in inflation to 2.6%. We got that 2 days ago. I was actually making this graph 3 days ago, so I didn't get in the latest number. But this is inflation in the US. The orange line is actual inflation, or what we call headline inflation. The blue line is inflation excluding food prices and energy prices. And you can see both have been picking up. And you can also see this goes to the end of 2022. So what I've done is I have assumed the growth rate of inflation of prices month on month in the past 6 months that continues. Then that will bring inflation to nearly 4% in the next couple of months in the US. But this was before I got the number for March. And there was actually quite a steep jump. So now it's a given that in the next 2-3 months, US inflation will move above 4%. Remember here, the inflation target of the central bank or the Federal Reserve is 2%. They have, however, what they call an average inflation target. The average inflation target is that they say that have we undershot the inflation target, as you can see, you, for example, did in 2020, early 2020, then they are, quote unquote, allowed to overshoot it for a period. But what if what I have here is not a forecast? This is just assuming that things continue as they did prior to March in this past 6 months. This is before we get the impact of all of that money that is now floating around in deposits that very soon or already has begun to move into the US economy. So I actually believe that we're going to face quite a substantial increase in inflation in the US. And some have said, why is it that stock prices have continued to increase so much as they have? I can actually show you a graph I have here a little bit further ahead. Here is the US stock market. The blue line is stock prices in the US, or share prices, equity prices. And the orange line is what stock prices should be if the stock prices were determined by where the nominal GDP is, how the economy is growing. And you can see that we are actually, the difference between the two now means that US stock prices are likely more than 40% too high relative to the size of the economy. And then you would say, is that a massive bubble? Is that 2001 repeated? And my point would be, well, what if it actually is that the nominal GDP is too low? What happens if prices jump by 10%? What happens then? Because then nominal GDP will increase. Nominal GDP is GDP production and inflation on top of that. So what if we concern ourselves with that, look at that? And that is actually what I have here. The orange line is the same model where I taking into account that money supply growth. And so what we can actually see here is that US stock prices are not overvalued, but they rather reflect that a lot of money will soon be entering the economy and push up prices and therefore improve earnings of companies. So what we are saying now in the stock market is really the stock market telling us that we are in for a major jump in the price level. And my point of view is that will happen very fast within the next 4, 5, 6 months. It's not something that will happen over 10 years. It will be a one-off jump in prices. And then later in the year, the Federal Reserve would say, okay, we didn't think that would happen. That was too bad. Now we'll bring down inflation to 2%. Okay, inflation is now, or unemployment is now down to below 5%. We have now full employment. We need to tighten monetary policy. They will scale back monetary easing. They will hike interest rates. They will do it much earlier than the market expects now. And that's where we might get into some headwinds. So where does that leave us in Europe? Well, Europe is just the shadow or the mirror of what is happening in the US. And that's why I have been telling this story here, because this is essentially a Euro story, but we will be importing that inflationary pressure from the US. And I think that would be very interesting to see how the ECB will react to this. You might remember back in 2011, 2012, the ECB failed dramatically by hiking interest rate at the wrong time and causing the euro crisis to deepen a lot. I don't think they will do that this time around. I think they will rather import the inflation from the US. And therefore, we should all be, as business people, essentially be thinking about we should hike prices. If you go to the hairdresser, can you get to the hairdresser in Lithuania? Because hairdressers have been closed down for months in Denmark. And now they are getting back. And now everybody's queuing to get into a hairdresser. How do you stop a queue? You raise prices. And all indications is that is happening very fast now. And that will be happening to hotels, to travel, to football matches, to basketball matches, to everything. Prices will be rising. And I think really, as a business person, that should be your concern. What do you do? Can you rise prices? And essentially, you have to rise prices because you will see your input prices go up rather dramatically. And it's probably maybe already happening. And obviously in Lithuania, you saw something similar to this because the economy was booming in 2006, 7, and going into 8. But this is a very, very different situation. This is not driven by a property market and imbalances in the economy. This is more like a one-off coming essentially from import prices rather than something domestic in Lithuania, because the situation in Lithuania is not as in the US. Lithuanians do not have a lot of money parked in their bank deposits. They have more than one could fear, but not necessarily not 20% of GDP as it's the case in the US. So I better stop now if we should have time for questions.
Yes, Lars, thank you very much. Do we have questions from the members? While we wait for the questions to come up, I have one question, Lars, from my side. Basically, you are telling that inflation is in US is coming.
Yeah.
But what is happening with the US dollar rate? Actually, that is becoming stronger against other currencies, and especially with regard to euro.
Yeah, and this is exactly this is, you can say that if you know, when one studies economics, you're taught about the so-called purchasing power parity, and the purchasing power parity tells you essentially what is also called the Big Mac index. If the price of a Big Mac goes up in your economy relative to the price of a Big Mac in another economy, your currency should weaken to get the price back to the same level. However, if the price of a Big Mac is going up in the US, then the Federal Reserve should be moving to tighten monetary policy to scale back what they've already done. So what we're seeing now, in my view, in the dollar is that the market is saying, well, we are going to have more inflation, and inflation is going to be too high, and unemployment is going to be too low. And therefore, the Federal Reserve will move to tighten monetary policy faster than we have until now expected. I think that process can continue. However, it's a little bit tricky in the present situation, because what happens if the Federal Reserve says, well, this is temporary. We will allow inflation to overshoot. What if the market says, oh my God, they are no longer committed to 2% inflation? What if they think that Janet Yellen, who was former the Federal Reserve chairwoman and now is the Treasury Secretary, and Jerome Powell, the Fed chief, are best buddies, and she will just run deficits and he will just print money to support those deficits? Then we'll have a very dramatic change in terms of the credibility of monetary policy, and that scenario would be extremely negative for the dollar. I don't think that we're going back to that kind of scenario where, you know, the US turns into quasi-Venezuela, but there is a risk that will be tested, and that would bring some volatility to markets if that were to happen. The most likely scenario, however, is that the numbers would improve in the US much faster than expected. The Federal Reserve would turn around, they would scale back these things, and then the dollar will strengthen quite dramatically. What is happening in Europe is that the situation in Europe is not the same. The economy in Europe is much, much weaker. And we're still struggling with the whole effects of the lockdowns, and we're not even moved out of it. And some places we're moving back into lockdowns. So we are not in the same position, and we haven't seen the same kind of fiscal and monetary stimulus. So the reason is here that the Fed might move in a more tighter direction once the numbers, it becomes clear for them that the numbers are actually improving much faster than they have been saying, while the ECB will sit around and say, well, we're not seeing that improvement in Europe. We're not seeing it at all, and we're not seeing the same kind of increase in inflation as we're seeing in the US. And therefore, in my head, I would say at the moment, if you look at the dollar is likely around 5% overvalued relative to the euro. But that reflects the fact that the US economy is doing much better than the Eurozone. So that overvaluation is justified. If you look 5 years ahead, the dollar is 5% too strong relative to the euro. If you look half a year ahead, well, I wouldn't be surprised if that was 10 or 15% stronger than against the euro. So I'm probably, it's a V turned upside down here if I were to give you a euro dollar forecast here, that is likely the direction I would see. And what we also see normally when the dollar is strengthening because the Fed is tightening monetary policy, we see risk appetite being hurt. So I have all year been saying, or since the beginning of the year been saying, 2021 will be a great year for the macroeconomic situation globally. The economies will rebound very strongly, but it might be a pretty bad year for stock markets because stock markets are looking into 2022, 2023. So we'll get a one-off effect now, but then we'll have these inflationary headwinds. We will see the dollar maybe strengthening, the Fed moving from easing to tightening, and that normally creates troubles. So enjoy it while you can. The next 6 months could become very, very good if you're a retailer, if you sell stuff. It might be concerning if you're importing stuff. And then hopefully we will have a smooth landing later in the year where we return to a more normal pattern as we come out of this. But somebody have talked about the roaring 20s. I think this might be the roaring summer of 2021, but it will end there. And then we go back to normal if we're lucky, and we go back to something bad if we're not lucky. The roaring part is you're drowning yourself in vodka for 3 months, and then you will see whether there's a hangover or not. I'm not necessarily think there will be a bad hangover, but I'm from a financial market perspective, I'm concerned about financial market volatility, and I wouldn't be putting on too much risk if I was invested in the stock markets. But paradoxically, how do you protect yourself from inflation? You go into the property market, you go into the stock market, you go into commodities. But what has been happening? That has already increased. So we can already see the inflation that is coming in the next couple of months. It's already reflected in those prices. Once we have inflation up, those prices will not. The stock market, for example, in the US is not, in my view, really overvalued by 40%. It's just telling us that if you look at the price-earning ratios, prices will remain stable, but earnings will go up because prices go up. But is that a great situation for the economy? I don't know. I think some people will be disappointed. All that nice money they have in their bank accounts, that will be eaten by inflation like that. So yeah, and how do you avoid that? Spend it.
Okay, Lars, sounds promising, at least economy-wise in the short run for half a year or so. But later on, we might expect some hangover. Seems to be.
I should say this is unavoidable because you can see the monetary stimulus has already happened. We shouldn't do anything to stop it. It should just be allowed to happen. That's the return of normality after a bad, expensive, unplanned vacation.
We got actually a related question. So you mentioned you have been telling a lot about the stock market. So is it a good timing for us to buy tech stocks now?
I don't know. Well, I have been for 25 years. I've been making a living forecasting things, and I normally say that I'm not better at forecasting anything than the markets. I strongly believe that market reflects the information that is out there already. And as I said, it looks like stock markets are overvalued, but if it just reflects the fact that prices are going up by 10%, retail prices, so to speak, consumer prices, then they're not overvalued. Then it's just the market being forward looking. So that makes it hard to say, what should you do after that? Obviously, all of my models indicate that stock prices are at a very, very high level. And obviously, if you look at tech stocks, what they have been, they're driven by all kinds of things. But one of the things is, of course, leveraging. That essentially, as long as growth in the economy is higher than nominal interest rates, they are funding themselves very cheaply, and that is good for growth stocks. That's always the case. So if you are in a situation now, let's say that we get this one-off jump, and then you have a situation where the Federal Reserve turns around dramatically and interest rates jump. So let's say the Federal Reserve move up interest rate by 1.5 percentage points over the next year, and growth stalls. Then the case for tech stocks become much, much less strong. I have no clue about the long-term growth potential of Tesla or Netflix or Facebook. I don't want to have a view on it. I can say I never made any successful investments in the Danish or in the stock markets in general. I always left it to my pension funds. I'm completely passively invested. I made some great investments in the Danish property market, but it had absolutely zero to do with economic calculations. It was just because that was where I was in my life at that time, where I was selling and buying. So I've been extremely lucky in the Danish property market for the past 20 years, but it's all to do with luck. So I might have been right about the Lithuanian economy in 2007-8, but I would never claim to know I know more about the future of the markets than the markets themselves. But that, on the other hand, makes me more clever than most investors, because they all tend to believe that they know more than everybody else, and then makes them make stupid decisions. I'm cautious at the moment, but I think that inflation issue, it's if you're going to have a jump in prices, you need to be hedged against that more than anything else. And that is just staying long the stock market, even though stock prices remain or looks rather pricey.
Okay. We have one more question coming from Jan, actually. There will also be a labor demand as more companies will move production to EU. What is your forecast for trends in production?
Well, I think, but the point is here that we have had the lockdown effects. A lot of people have been, what essentially said is like we have this very odd situation that we don't have a connection between supply and demand. Demand have been shut down regardless of the demand situation. And of course, demand has dropped, but not because of underlying trends in income developments. So it's very hard to see where we are. But I think essentially we are in a situation globally where demand is going to outpace supply quite dramatically. Jan, more than anybody, of course, knows about logistics and shipping. We have seen dramatic supply constraints. Some of it, of course, we have the Suez issue, we have China, but anybody who looks at, for example, to electronic prices, DRAM prices, seeing that gone up, we're seeing freight rates go up. That is all telling me that we have quite significant supply constraints. And you can try to meet that by hiring more people. We haven't seen unemployment go up dramatically, despite the fact, in Europe at least, despite the fact that a lot of sectors have been closed down. I think it's important to understand that this crisis has been about sectors rather than the entire economy. It has been about certain sectors being closed down, but other sectors have continued to working. And as we come back, we open up the economy, demand will outpace, for the next 6 months, outpace supply. I think we have a long, and as Jan also would tell you, supply chains take time to work through. If we have a constraint problem today, that will keep on pushing up prices in the next 6 months, no matter what. And I think we will get stories in the quite near futures about components that we can't get, for telephones, for all kind of components. You have a factory and you can't get your components. There's only one way to fix that problem, is to increase your own prices, to reduce the demand you have for your own goods, and to make money in that way. So I think so of course that will increase labor demand. And on the other hand, unions, employees will come around and say, we need a salary increase because unemployment is down and we're seeing prices go up. We need more salaries, and companies will be eager to pay those salaries because demand will be very strong in the next 6 months.
So again, talking about the producers in Lithuania, we have noticed that recently we have quite significant increase in raw materials like metals, like also impacted also by transportation cost increase. So what would be your recommendation? Should we buy some stock or let's say raw materials into stock, or?
Well, I think that's a quite tricky question. I think I do think that this. If you look at spot property or commodity prices, for example, the price of copper or steel, those are forward-looking markets. So it might be that the impact of the demand squeeze or the demand increase relative supply has already been noticed, and that this runs a course. I actually think we might have seen what we will see on commodities, or at least some of it. But for the next couple of months, the Federal Reserve will try to tell financial markets that will not tighten monetary policy, and will tell financial markets that inflation expectations will continue to move up, and with that, commodity prices. But at some point, it will become obvious that the Federal Reserve will have to reverse. Once that happens, you get a major correction in commodity prices. And I'm not entirely sure that I don't think we're past the peak, but I wouldn't be buying wholesale for stock if I have a 1-year outlook. I certainly wouldn't be doing that, because I think that the Federal Reserve, which is the most important thing, reverses course within the next 6 months, or maybe even before that.
Yeah, Lars, you mentioned that in the US we have a significant increase in liquidity, meaning cash is there. Yeah. Actually, that is replicated in Lithuania as well. And basically, we saw that during 2020, we had increase in deposits in the banking sector by 3 billion euros in Lithuania. Of course, that is not comparable amount to US, but that is still a significant increase in Lithuania for Lithuanian market. This indicates that companies, they are keeping, profits accumulated. They are not investing. So what would be your recommendation for the organizations in Lithuania, for producers, for companies in Lithuania? Should we still keep cash to be on the safe side? Should we invest? Should we pay dividends?
I would be rather concerned that some of that cash will be eaten by higher input prices and higher salary demands, and that could happen pretty fast. So I would maybe if you're an average Lithuanian production company, add 15% to your input prices at unchanged prices, and do your assessment of how would you, in that situation, how would you then maintain your production at present levels or higher levels? how would that affect your cash situation or your liquidity situation? Because I think you need to correct your liquidity for the fact that you might see this jump in input prices. And that would eat your liquidity very fast. And so it might be that you have ample, and of course, the fact that this is tricky. You know, we're not used to inflation anymore. In Lithuania, you are more used to it than if you went to Denmark or to Sweden. They have no clue. Well, some of the participants here are old enough to remember inflation in Denmark in the early 80s. Jan is shaking his head, but he remember well when we had 10% inflation in the early 80s in Denmark. We had interest rates of 22%. But this is, it's somewhat different, because I really think that we have this one-off jump rather than a continued inflation. And think about that one-off jump as somebody who comes and take 10 or 15% of your liquidity overnight, and then say, okay, we took that out. That is precautionary to ensure ourselves that we can keep on operating if input prices were to go up. Then you are safe. So I think you need to hold more liquidity, even though that liquidity will be eaten. But that's just operational liquidity.
Clear. Again, you are forecasting that the recovery is going to be inflationary. This indicates that most probably the market interest rates will grow up.
Yeah.
Is it a good time for us to hedge interest for the credits we have?
Absolutely. I've been arguing that for the past 4 or 5 months. That I think that, and again, I said I tend to very much think that markets are right, that I cannot beat the market. But it is very long time since I felt this strongly that the market is wrong. I think that the pricing of interest rate development is very, very off, and I think that we could see, in terms of short-term funding in euro rates, I think we have upside towards 100 basis point, 1 percentage points within the next half year. I think that there is a quite significant interest rate risk there. If I had interest rate exposure, I would fix it for the next 2 years. I'm not, you know, I don't think long-term interest rates are that much off. But if you think, if something that is comparable, if you look at where US 10-year bond yields are now, they are just below 2%. I see them above 2.5%, closer to 3% within the next year, but not at 4%. To go to 4%, you need the Federal Reserve to fail, to become like they were in the 1970s, inflationary. When I talk about this, I have to stress, I talk about a one-off jump in prices rather than I see higher inflation for the next 10 years. That's not what I'm seeing. But I see there's a risk that we might be moving more in that direction as well. And at the moment, think about a lot of the reason why bond yields are this low is the same. What do you do at Danske Bank with all that nice deposit you have? You know, you have a lot of households and corporations that put money into Danske Bank in Lithuania, and you sit around with all that cash. What do you do with it? Well, if you don't send it to headquarters in Copenhagen, you put it directly back into the market. You buy safe assets. What's the most safe assets in the world? Government bonds. So, or they're supposed to be. So you're buying that. So that has depressed bond yields. Once that money starts to move out of deposits because inflation is going up, because people start to spend that much money, they will disappear from the balance sheets of Danske Bank, and you will sell that bonds and bond yields go up. So I think there is this rationing effect in bond yields, and I think actually that's why markets are right, because they are not necessarily reflecting our expectations of where the economy is, but the fact that banks and financial institutions have just been floating in all of that deposits that they need to place somewhere temporarily. And they need to place it somewhere safe, and that's in government bonds. So,
okay.
Yeah.
I see. And basically the last question in my list, and we will have to return already the floor to Laimonas. So that is regarding the investments again. We all know that actually gold is most often treated as, the safe investment in case of, turbulent situations. In Lithuania, that is not so much, the case. Quite often Lithuanians, they are investing more into properties, especially residential properties.
Yeah.
And is it a good time for us now to invest actually in those properties? Lars, your opinion?
Well, we know where near where we were in 2006-07 on property prices in Lithuania, and the situation is markedly different. If you ask me about Scandinavian property prices, I will tell you a story about the underlying growth in the economy, and I will tell you about positive demographics. And there, of course, the Lithuanian story is much different from the Swedish story or from the Danish story, where we are very positive, where we have a fairly positive demographics. We have a population that is aging, but in Lithuania we've had a situation of people leaving the country and stagnant life expectancy. So you don't have the same demographic tailwind in Lithuania helping the market. So I just want to stress that. What really is the tricky part here is that property prices might have increased too fast. But what's your alternative? What is that, to keep more cash that will be eaten by a 10% increase in prices? Is it to put it in Tesla, which is insanely high levels for the price level? Is it to put it in gold, which is also apparently very high? So, in the last, 3 or 4 months ago, I came to the realization, I was looking across asset classes, and all of my econometric models for these prices was telling me that all assets, gold, silver, copper, property prices, equity prices, the bond market, it was all too expensive. So if everything is expensive, what do you do? How can everything be expensive? Because not everything can be expensive. Something has to be expensive relative to something else. But all of my models were telling me everything was overvalued, until I realized that what is not overvalued is the economy, because you measure everything about the size of the economy. And once you then say, okay, prices go up by 10% in one half jump, nothing is overvalued anymore. Everything is perfectly valued. So I'm getting back to this inflation question, that property prices might be high in Lithuania, but what if the economy grows by 5-6% this year, or 8%? And that could easily be the case. And then you add 5-7% increase in the price level on top of that, then nominal GDP in Lithuania is up, let's say 13-14% in 1 year. Suddenly property prices do not look overvalued. So that's the tricky part. That's the tricky part. But obviously this, if I'm completely wrong about inflation going up, then you better get out of the property market in pretty fast. I'll use the case of Jan. Jan is old enough to have been buying property in the early 80s in Denmark. He couldn't afford it, but inflation paid off the whole thing. Or maybe, let's just be nice, Jan's great-grandparents did that in the 70s. What will happen is that a situation where inflation can eat up your debt, and I think actually that is what's going to happen now. Not all of it, but that is a one-off, and that's why all asset prices are wacky right now. I think I'm circulating about the same story here, but it's really what you can see in all prices right now, that we are taking out. It's like, imagine you're looking at macroeconomic numbers, and somebody says, we're just removing one of the half years of the numbers. We're just taking out, and then you said, guess what happened in between? And it's like, okay, what happens in between is that US unemployment goes to 15%, the money supply jumps by 27%, unemployment drops to 6%, deposits increase by what amounts to nearly 20% of GDP. And you would say, no, that's insane. That's an insane scenario. That cannot happen in 1 year. Well, that happened, and we have seen the effects in all the asset prices, but we haven't seen the effects in the economies, because for the case of the Lithuanian economy, you are back to communism. You still are in a communist situation. You were out of communism for 30 years. Now you're back to communism. We are in Denmark as well. What shops can be open are regulated. What times they can be open is regulated. Everything is regulated. Once that happens, we will have a return to free markets. But that is then at a money supply which is 20% higher. And then we will settle in a new price level. So it's post-communist times. I don't say that it has been wrong to close down everything. Well, it has been. But it's just such a dramatic thing. And we'll have a one-off reaction to that. Yeah, I keep on talking. So...
Okay, Lars, thanks. I always thought that we are running so heavily, from the communism for a number of years, and now you are telling you we are back again in the communism.
Yeah, and your prime minister hates communism, so I think she will hopefully soon get you out of it.
Okay, see, good. Nice to know that. Do we have any last question from participants?
I personally would like to say thanks to you, Lars. It has been outstanding as usually. And I hope that you will manage to ask Ingrid that question next year at our session. So
I
see.
hope next year we will do the session in Vilnius, or maybe we will do it in Kaunas, mostly for the basketball. But yeah, I hope we can do it in Lithuania, and I look forward to returning back to Lithuania very soon.
I would like to say on behalf of the Danish Chamber, it has been outstanding, and I think you have had a very heavily come back to Lithuania in the first months of this year. Let's hope it will continue.
I'm looking forward to the boom, and what happens, of course, is I'm raising my own prices dramatically these days.
What a final comment. Thanks, Lars.
Thank you. Bye-bye.
Thank you very much, Lars. Bye-bye.